The world had been warned for decades that the petrodollar, America's most powerful instrument of global dominance, would not last forever. Economists saw the fractures forming long ago. Historians wrote endlessly about the dangers of a financial empire built on military protection and energy dependence. But no one expected the final push to come from Africa. No one imagined that the continent Washington once dismissed as a development client would one day hold the power to shake the foundations of the global financial order. And yet, that is exactly what unfolded. Quietly at first, then with seismic force, Africa began rewriting the rules of energy, currency, and global influence. For nearly 50 years, the petrodollar system ensured that almost every nation on Earth needed U.S. dollars to purchase oil. From Saudi Arabia to Nigeria, from Angola to the Gulf monarchies, oil sales were tied to the American currency. This arrangement guaranteed two things: global demand for the dollar and American leverage over international markets. With each barrel sold in dollars, the United States secured what no other empire in history ever possessed: unlimited access to global wealth without the need to colonize territory. The dollar became a modern weapon, one stronger than any aircraft carrier or nuclear warhead. But Africa was changing, and with it, the pillars of the petrodollar began to show signs of collapse. The shift started not in Washington or Riyadh, but in the bustling markets of Lagos, the deep gold mines of Mali, and the offshore drilling platforms off the coast of Namibia. African nations, long pressured into accepting Western monetary frameworks, were beginning to question why they should continue trading their most valuable resources, gold, oil, lithium, cobalt, in a currency they did not control. These were not merely ideological questions, but practical ones born from decades of economic instability, currency manipulation, and sanctions used as diplomatic weapons. African leaders studied global trends. They watched Russia survive sanctions by turning to yuan and gold. They saw China build entire trade ecosystems outside the dollar. They witnessed BRICS nations creating payment systems insulated from Western control. And as the United States battled its own internal debt crisis, crossing $36 trillion with no signs of slowing, the realization spread: the dollar was no longer the unshakable pillar it once had been. Meanwhile, Africa's economic landscape was transforming. Geophysical surveys revealed enormous gold reserves across West Africa, previously underestimated or intentionally ignored by foreign companies. New oil discoveries in Namibia, Uganda, and Senegal revealed billions of barrels that would rewrite Africa's role in the global energy supply chain. Countries like Ghana, Egypt, South Africa, and Zimbabwe began building financial mechanisms anchored not in dollars, but in gold, the world's oldest and most resilient store of value. What began as isolated national decisions soon became a continental dialogue. Finance ministers met quietly. Central bank governors exchanged research. Presidents formed alliances not advertised on Western media. There were discussions of an African commodity-backed settlement system, a framework that would allow nations to trade oil and minerals using their own currencies, backed by gold reserves or digital equivalents. For the first time, Africa was considering a financial architecture built on its natural wealth, not on imported currency systems. Washington noticed, and Washington panicked. The United States had spent decades nurturing close relationships with African oil producers, from Nigeria to Angola. It relied on African mineral exports to maintain technological dominance, especially in the growing electric vehicle sector. But more importantly, America depended on African nations accepting the dollar as the default currency of global trade. If Africa left the petrodollar system, a major pillar of dollar demand would vanish. And if Africa embraced gold-backed trade settlements, it could inspire Latin America, Southeast Asia, and even the Middle East to do the same. The first shock came when Zimbabwe launched a gold-backed digital currency, technically sophisticated, legally binding, and designed to bypass the volatility of the nation's previous currency struggles. Critics in Western financial circles dismissed it as symbolic, but central banks across Africa took note. The second shock followed when Ghana announced plans to buy oil in gold rather than dollars. Economists in New York and London scrambled to downplay the significance, but investors saw the writing on the wall. Then came the third shock, more dramatic, more coordinated, and more decisive. A coalition of African oil producers, mineral exporters, and gold-rich nations began negotiating a unified settlement mechanism independent of the dollar. Rumors circulated of an African energy exchange, where countries could trade oil and gas in local currencies or digital assets backed by gold reserves. Central banks expanded their gold holdings at the fastest rate in 30 years. The West dismissed these moves as impossible, then improbable, then abruptly, frighteningly realistic. At the core of this momentum was a larger strategic shift. Africa no longer wanted to be a raw materials hub feeding the industrial engines of the West at bargain basement prices. It wanted to refine its own oil, process its own minerals, mint its own gold reserves, and control the value of its own currencies. It wanted to build the factories, the refineries, the industrial corridors that would transform the continent from an extraction zone into a global manufacturing force. And that vision could not coexist with a petrodollar system that kept Africa dependent, vulnerable, and subordinate. African leaders saw the geopolitical landscape clearly. The U.S. debt crisis was spiraling. The IMF and World Bank were losing influence. China was accelerating investment on the continent. BRICS was expanding rapidly, forming a trade bloc with the ability to challenge Western monetary institutions. And beneath all of this, a new generation of African citizens, literate, connected, ambitious, was demanding economic sovereignty. They demanded control of their resources and their future. They demanded an Africa that exported finished goods, not just raw materials. And above all, they demanded liberation from the dollar. The shift was not simply financial, but deeply political. By reducing reliance on the dollar, Africa reduced exposure to sanctions. It reduced vulnerability to inflation exported from the United States. It reduced dependence on Western commercial banks that had historically dictated the terms of African development. In short, it reduced American leverage. Washington understood this. That is why the reaction from the United States was swift and unusually aggressive. Diplomats warned of financial instability. Economists warned of uncertain consequences. Media outlets warned of authoritarian influence on the continent. But none of these warnings addressed the core truth. Africa no longer needed to ask permission. As the strategy evolved, gold became the cornerstone. African nations held some of the world's largest undeveloped gold reserves. By monetizing gold internally, through sovereign vaults, state-backed certificates, digital assets, and commodity exchanges, Africa could create a currency system more resilient than the dollar. And oil, long used as a tool to sustain the petrodollar, became the second pillar. Instead of selling crude to Western refineries at discounted rates, new African policies prioritized domestic refining, regional pipelines, and continental energy corridors. For the first time in modern history, Africa envisioned a future where it controlled the price and flow of its own resources. A future where its wealth circulated within the continent, not siphoned away through offshore banking systems. A future where Africa's bargaining power surged, where its leaders negotiated on equal terms with Washington, Beijing, Brussels, and Moscow. A future where no foreign nation decided which African country had access to its own financial systems. The global shock intensified when major oil nations signaled openness to accepting non-dollar payments, including digital assets, gold-indexed currency units, and even continental stablecoins backed by commodity baskets. This was not just a departure from the petrodollar. It was a direct challenge to the financial architecture on which U.S. influence was built. The dollar's supremacy depended on nations needing it, but Africa was removing the need. Investors noticed immediately. Hedge funds began diversifying into African mining firms. Central banks increased gold purchases. Even Western corporations began quietly preparing for a world where the dollar no longer dominated global energy. The shift was irreversible. Behind closed doors, U.S. officials confronted an uncomfortable reality. Washington could no longer dictate Africa's monetary choices. Africa had leverage. Africa had partners. Africa had strategy. And Africa had youth, hundreds of millions of young people who would define the next century of global economics. The end of the petrodollar would not come overnight. It would not collapse in a single dramatic headline. Instead, it would erode gradually, steadily, relentlessly, just as Africa's alternative systems expanded. And as Africa traded more of its oil in gold-backed frameworks, the world adjusted. As Africa processed more of its minerals domestically, global supply chains recalibrated. As Africa built financial institutions aligned with BRICS, the Global South found a new template for economic freedom. The consequences for Washington were profound. Without the petrodollar, America would face a world where its borrowing power weakened, where inflation could no longer be exported with ease, where sanctions carried less weight, where international trade diversified into multiple competing settlement systems. In such a world, America would have to compete fairly, without the hidden advantage of currency dominance. Africa's rise did not mean America's collapse, but it did mean the end of automatic obedience. It meant the end of a world where Washington's financial decisions shaped every African economy. It meant the emergence of a multipolar world, one where Africa was not merely present but powerful. In capitals across the continent, leaders spoke quietly but confidently. Africa was no longer asking for a seat at the global table. Africa was building its own table, and it was bringing the world to it. The petrodollar era that had shaped global politics for half a century was fading, and in its place, Africa's new gold and oil strategy was redefining what global power looked like in the 21st century. The West could not stop it. Washington could not reverse it. The shift was rooted not in ideology or sentiment, but in fundamental economic reality. Africa now understood the value of its resources. It understood the power of unity. It understood the consequences of dependence. And it understood the historic opportunity before it, a chance to break free from centuries of financial constraint and step into a future defined by sovereignty. The world was entering a new era. The dollar would remain important, but not invincible. Energy would remain crucial, but no longer concentrated under one currency. And Africa, long underestimated, long undervalued, was now leading one of the most significant economic transformations in modern history. The end of the petrodollar was not a disaster. It was a rebalancing, a correction. The world had changed, and Africa was no longer a spectator in that change. Africa was the catalyst. Africa was the frontier. Africa was the force shifting global power in ways Washington never saw coming. And as nations repositioned themselves for the decades ahead, one truth became unmistakably clear. The center of gravity was moving south, and Africa was rising to claim its place at the core of the new global order.